We are currently building the most powerful artificial intelligence chips in human history, but we're rapidly running out of places to actually plug them in. It's a really fascinating contradiction when you think about it. Right now, localized opposition over land, noise, and power grid capacity has already stalled up to $162 billion in data center projects. This massive physical bottleneck is colliding head-on with accelerating financial momentum, and it is completely reshaping the global semiconductor market as we know it.
For the past year, the market narrative has been utterly dominated by one single name, but that era of the single-player monopoly is officially over. AMD's first quarter 2026 earnings beat wasn't just a nice quarterly financial win. It was the definitive signal that the structural landscape has shifted. AMD is no longer just an opportunistic challenger trying to grab scraps. It has firmly secured its place as a true data center incumbent.
And this marks a profound institutional shift. We've reached a strategic inflection point where AMD has officially surpassed Intel in data center revenue. This is a monumental changing of the guard, and it's prompted Wall Street to fundamentally re-rate AMD stock. It's no longer being valued as a cyclical, legacy semiconductor manufacturer. Instead, it's being assigned the premium, high-growth multiple of a critical AI infrastructure giant. The sheer scale of the capital involved here is staggering. We're talking $10.25 billion in total revenue for the quarter, paired with a record $2.6 billion in free cash flow. That cash flow number is, well, actually, it's the absolute most vital metric here. It's proof. This massive influx of liquidity demonstrates to cautious institutions that the current AI build-out is a self-sustaining cycle backed by real cash generation, rather than just some capital-burning speculative bubble. Meta recently announced plans to dedicate up to 6 gigawatts of power to AMD Instinct GPUs across several product generations. 6 gigawatts. To put that into perspective, that is enough power to run millions of homes entirely. So why would Meta dedicate a small city's worth of electricity to a single vendor's hardware? It reveals the immense physical skin hyperscalers have in the game right now. They are aggressively engineering their way out of vendor lock-in because to survive, they absolutely need options.
So the crucial point is understanding why this hardware landscape is shifting so violently in the first place. It really comes down to a fundamental evolution in how artificial intelligence operates. We are moving from the era of simply teaching AI to the era of AI actually working autonomously. This is known as agentic AI. And because these autonomous systems require highly distributed, real-time computing across the cloud and the edge, the market suddenly and desperately needs high-performance central processing units, CPUs, not just GPUs. Think of the previous era of AI training. It was defined by massive, localized clusters of GPUs just churning through mountains of data. But the agentic AI era is fundamentally different. It relies on large-scale inference, it's highly distributed, and relies heavily on server CPUs to orchestrate these incredibly complex workloads. This shift is precisely why companies with leading CPU architectures are suddenly finding themselves right back at the very center of the AI revolution. Now, this architectural shift is showing up directly in the financials. The data center segment surged 57% year over year, and now accounts for 56% of AMD's total revenue. It has literally become the primary economic engine of the entire company. This isn't some random fluke. It reflects a much broader macro shift. Enterprise customers are moving away from those speculative small-scale pilot programs and are now executing massive production-level deployments. Because of this transition toward agentic AI and distributed inference workloads, the long-term math has completely changed. AMD previously forecasted the server CPU addressable market to grow at 18% annually. They have now dramatically revised that upward to more than 35% annual growth through 2030. They are effectively doubling their long-term growth expectations entirely because of this reemergence and critical necessity of the CPU. Naturally, markets react to this kind of structural validation. What we witnessed in early May of 2026 was a pure period of rational exuberance. Following AMD's validation of sustained demand, the Philadelphia Semiconductor Index hit a fresh record high, capping an unprecedented 18-day winning streak. And this wasn't driven by blind hype. It was driven by institutional relief. Relief that the total addressable AI pie is in fact large enough to support multiple, highly profitable leaders. This realization triggered a massive rotation of capital. Investors began moving away from what analysts were calling vibes-based trading and returned to fundamental investing.
We are witnessing the ultimate catch-up trade. Investors who previously focused solely on Nvidia are diversifying across the entire value chain, driving up valuations for AMD as its trajectory begins to mirror the exact kind of explosive, fundamental growth that Nvidia experienced a year prior. But look, explosive growth always brings operational danger, specifically in the supply chain. Smart companies build strategic escape hatches. We are seeing institutional incentives driving hyperscalers to aggressively diversify their hardware, even co-designing custom architectures like Meta is doing with AMD's MI450. Furthermore, to avoid tight advanced node capacities, AMD is securing the literal oxygen of the AI industry, which is advanced memory, by bypassing traditional bottlenecks through a vital partnership with Samsung for HBM4 memory. When you combine that strategic supply chain management with surging demand, the financial projections shift dramatically. Wall Street analysts now suggest that a $20 earnings per share target by 2028 is a highly realistic scenario. Because there's such clear visibility into upcoming product cycles like the Venus and Helios lines, institutions can model this growth with a degree of confidence that simply didn't exist 12 months ago. And those upcoming product cycles matter deeply because the actual rules of procurement are changing. AMD's upcoming 6th-gen Venice processors reportedly deliver more than twice the throughput of leading ARM-based solutions. But it's not just about raw speed anymore. It's about an economic reality where performance per watt is now the absolute most critical metric for data centers. You can have the fastest chip in the world, but if you can't cool it or power it, it's completely useless. Which brings us to the harsh macro constraint, the physical reality check. We have the brilliant chip designs. We have the highly sophisticated software ecosystems. But the future of this high-growth sector is colliding incredibly hard with the physical realities of our world. Grid power limits, noise pollution, and intense localized opposition are now dictating the actual pace of deployment across the country. It leaves us staring at a profound reality about the nature of this technological revolution. We are pushing the absolute boundaries of silicon logic and digital software. But all of it, every single piece of it, remains entirely dependent on steel, concrete, and copper wires. So the ultimate question isn't whether the software will be smart enough, but rather, are we entering a world where the speed of AI is limited by how fast we can dig a trench?
An investment in knowledge pays the best interest, so why not invest in this channel? Click like and subscribe for more.